ICAI students, let's revise CA Final AFM, Chapter 13 Business Valuation, Practical Question 16. Constant Engineering Limited has developed a high-tech product which has reduced the carbon emissions from the burning of fossil fuel. The product is in high demand. The product has been patented and has a market value of 100 crores. So the product value is 100 crores. And product's patent value is 100 crores, which is not recorded in the books. That's fine, but that will be a part of our invested capital. The net worth of constant engineering is 200 crores and long term debt is 400 crores. So this 200 plus 400 plus 100 will be our invested capital. The product generates a net operating profit after tax of 84 lakh. They've only given net operating profit after tax, so we can simply take this, and we have to reduce the capital charge, nothing but the invested capital multiplied by weighted average cost of capital. For the weighted average cost of capital, we need to calculate the rate on 365 days government bond is 10%. So the same has to be considered for our debt also. The company has not clearly given us the debt percentage, the KD, so we can consider the cost of debt as this 10% itself. And the question has not specified the tax rate also, so this 10% is assumed after tax, or considering the tax as 0, the cost of debt, and then after tax cost of debt also remains same. So 10% can be calculated, 10% can be considered as KD, and we need KE. For that, market portfolio generates a 12% per annum they have given, so which is nothing but RM 12%. And they told the stock of the company moves in tandem with market. So this tandem with market signifies that the beta of the company is 1, which means beta is nothing but the sensitivity towards the market portfolio, which signifies it moves parallelly towards the market portfolio return. The stock return moves parallelly towards the market portfolio return, which means if stock is increasing by 1%, if the market portfolio is increasing by 1%, the stock return also will increase by 1%. So keeping that assumption, market portfolio generates 12%, so the KE also will be 12%. Or using CAPM model, even if you substitute all these values, so we know that risk-free rate is 10%, government bond risk-free, that is the risk-free rate, and beta is 1 because it is tandem with the market, and RM is 12%. So 0.1 plus 1 multiplied by 12 minus 10, which is 2% is the market risk premium, plus the 0.1, it is nothing but risk-free return. So overall the return also is 12%. Hence KE is equal to 12% in our case. Now they are asking us to calculate economic value added. So now we have the information of NOPAT. So economic value added is nothing but NOPAT minus capital charge. Capital charge is nothing but invested capital multiplied by weighted average cost of capital, and weighted average cost of capital is nothing but KO equal to KE multiplied by E by E plus D, the weight of equity, plus KD, this is after tax cost of debt. As previously told, this question does not specify the tax rate, so hence whatever 10% government bond is there, we will be taking it as cost of debt. If tax percentage is given, then we have to adjust this 10% with tax. So KD multiplied by D by E plus D, the weight of debt. Okay, now we know the cost of equity is 12 percentage, and cost of debt is 10 percentage, and we know the equity portion. If the debt is 400, then the remaining will obviously be equity. So 400 plus this 300, 700 is the total capital. So 700 is the total capital. Out of that, 300 is the equity. This will be the weight of equity, and for debt it is 400 by 700. Okay, now solving this, the overall cost of capital is 10.85 percentage. Okay, now the profit earned, net operating profit after tax, they have given 84 crores, and then the invested capital is 700 multiplied by the overall cost of capital 10.85. Hence the economic value added is 8 crore 5 lakh. So as previously discussed in our questions, economic value added is nothing but the extra value the company is creating over and above its cost of capital or the capital charge. Here in our case, we can see the operating profit, net operating profit after taxes is 84 crores, and the cost involved for this is 75.95 crores. So the cost is 75.95 crores, and the company is earning a net operating profit after taxes of 84 crores. Hence the extra value created is 8 crore 5 lakh. That's it. Thank you.